Good afternoon. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website at pacificpoint.net/research-lab. And while you're there, be sure to sign up to receive our research delivered directly into your email inbox. Let's go ahead and begin working through the process of determining when the Fed is likely to stop raising rates. Historically speaking, the ISM Manufacturing Index that you see on the screen here has been one of the most reliable indicators for Fed policy changes. For those of you that have been listening, watching my webinars over the past, you know that we talk about this chart all the time. Interestingly enough, last week, ISM Manufacturing actually missed, and coupled with news out of the UK, it actually sent markets on the strongest two-day rally we've had in several years. And this was based on speculation that the Fed might taper or pause their rate hike ambitions. This was actually a head scratcher for us because the slowdown in manufacturing post-COVID is really, really old news. And you can see that by looking at the chart. It actually started slowing down in the early part of 2021, okay? And we've seen inventory bloat beginning in Q1 of this year, and it's basically been driven by that post-COVID consumer demand shift away from goods to services consumption. And that's continuing to fuel inflation to this day, right? So we know that. Historically speaking, ISM manufacturing and services indices have tracked one another fairly closely. And this really speaks to its reliability as an indicator for Fed policy changes. And I want everyone to make note of the depth of some of these contractions. So I'll get my laser pointer here and turn it on. And first thing I want to point out is this decline in the progression of this manufacturing index. So you can see that we're still expanding, right? Because anything over 50 is expansion of the manufacturing sector itself. But that growth has been slowing, okay? And this is when it actually started here at the beginning of 2021. So you can see here, once we start approaching 50, and I've got slides to illustrate this here in just a few minutes, the Fed becomes accommodative in their policy, okay? So you can see here, when we don't go into recession, the Federal Reserve will normally provide some sort of easing, okay, some sort of change to their policy to ease so that we bring the manufacturing up towards expansion. And you can see that when we fall into recession, it's very common, okay, for the ISM Manufacturing Index to fall into the 40s, low 40s, mid 40s, even down into the mid 35s in the case of the financial crisis, okay? So let's go ahead and take a look at this concept of manufacturing. We need to establish a baseline for manufacturing versus services contribution to U.S. economic activity. And if you look at the screen up here, you'll see that I've got manufacturing as a percent of GVA, right? And we prefer GVA versus GDP, just given the inflationary environment that we're in. The reason for that is that, if you recall, gross domestic product is basically the final value of goods and services for a country. In this case, obviously the United States. GVA is basically the same calculation, except it subtracts out the input costs, right? So we prefer GVA as a measure for this type of sector contribution. In other words, we're looking at manufacturing sector versus the services sector. It's going to allow us for a more accurate cross-section of sector comparisons here, and that's what we're doing. So using manufacturing as a percent of GVA, okay, the manufacturing sector is only 12% of the US economy, okay? That's opposed to the services sector being 80% of US economic activity, okay? Keep in mind, this is more or less net of inflation, so it's a good comparison of the two. So this is the cover page of last weekend's edition of the Wall Street Journal. And you can literally look no further than last month's job report to find the importance of the service sector. Not only is it 80% of overall US economic activity, but if you flip to page 2 in last weekend's journal, you'll see that that the labor market gains year to date have been driven almost exclusively by services. Okay, so now we're kind of compounding this issue. Not only are we bringing services even to a more significant light, but we're compounding it now with the labor market. All right, so 80% of U.S. activity driving all of the year-to-date, I should say nearly all the year-to-date labor gains. And yet all the pundits and economists are effectively dismissing this dysfunction in the labor market as a lagging indicator. And it's true, right? The labor market itself is a lagging economic indicator, but sadly, these conditions have not improved much. And a lot of it is due to the continued strength of the services sector, right? Which is one of the reasons why the Fed continues to keep their foot on the gas. Obviously, we've got issues with energy and shelter/housing, but here's what we're looking at, right? And if you guys have seen past webinars and you've read our research, you'll know this chart. Good news is it's actually updated through today. So we've actually got today's CPI print, which obviously came in hot, 8.2%. You can see that here. Stubbornly high, just not coming down. You can see the average hourly earnings of private employees more or less stuck at 5%. So you've got more or less paycheck erosion going on. And with this high CPI print, corporations like Pepsi that reported earnings just yesterday, their most recent quarter, they've actually raised their prices 17% year over year, right? That's what happens when you get this type of CPI read. Everybody anticipates this continuing, and this cycle of increasing prices just continues, and Pepsi's the latest to do it. So Pepsi's really challenging the consumer, right? The consumer's got less money in their wallets effectively because of inflation, and then Pepsi goes and raises their prices by 17% on average. That's on average across all categories over the last year, okay? So why did they do that? Well, PepsiCo employees and others are facing a labor productivity issue, right? Labor productivity has slipped 2.4%. So in order to achieve the same volume of output, right, they've got to hire more bodies, more employees, more workers, because each of their current employees are producing less. So this cycle just continues to feed on itself, and it's basically squeezing margins and raising inflation on all sides. So you can see that we've got this wage price spiral here, and then obviously the case that I just outlined for PepsiCo, that's more or less a spiral as well. So this is really kind of the heart of the matter the Fed is looking at here. Yes, it's a lagging indicator, but wow, do we have some structural problems that we've got to deal with? So let's bring in the comparison of now manufacturing versus services. And so to do that, the best way to look at this is to take a direct read of the manufacturing index, and the preferred measure that we like is the ISM relative to the services index, also reported by ISM. So ISM is a great organization. They're actually located in Tempe, Arizona, and they do survey work, and it's some of the most followed, some of the most accurate survey work available. The Federal Reserve pays a lot of attention to it. And what I want everyone to notice again is that 50 baseline, right? This marks the difference between economic expansion and contraction. And what I want you to notice is this diversion, right? This is the post-COVID recovery of services and the abandonment of demand for goods. So you can actually see that shift in consumer demand away from goods, right? So manufacturing falling, continuing to fall, and goods skyrocketing to all-time highs. And this is really hot expansion of the services sector. And interestingly enough, you can see that in terms of economic activity, the current decline that we're experiencing is being led by the manufacturing sector. Well, keep in mind that manufacturing is only 12% of US economic activity, right? Let's take a look at what's going on with services, okay? Services is proving to be very sticky. It's still at 56.7, right? These numbers were just released last week. And so what I want everybody to see is as these pundits and economists and speakers and guests on CNBC are coming on saying, hey, the Fed's got to stop, the Fed's got to stop. or we're going to cause a recession. Well, the interesting thing is that if you look back here to the dot-com bust and that pre-dot-com bust era, you can actually see what the Fed is doing, right? It's interesting that a decline in manufacturing or a contraction in the manufacturing sector led us into that recession, all right? And you can see how far the ISM Manufacturing Index actually slipped prior to going into a recession. We were literally in the low 40s before the recession started. Why is that? Look no further than services. Interestingly enough, I have this circled in red relative to the current points because I want you to notice that we're in the exact same scenario we were prior to the dot-com bust, okay? Now, obviously, a little difference in equity valuations, a little difference in technical fundamentals for, and I'm not talking technical analysis, I'm talking about the technology sector. But from a manufacturing versus services perspective in terms of growth, okay, we're literally in that same exact scenario. And so what we can expect from the Fed is for them to perhaps continue their fight to bring this services demand down, right? We already know that that's causing or contributing to massive dysfunction in the labor markets. We know that it's 80% of US economic activity, right? So the bulk of this demand that we're seeing is probably coming out of services here. And so it's interesting that what we can expect is perhaps this ISM Manufacturing Index to more or less fall to some lows similar to this. And as it does that, you'll see the services index fall as well. So that's kind of what we're teed up for. But let's go ahead and begin building out our case, and we'll have some fun with these charts. So what we're going to do now is we're going to keep this chart up on our top panel, and we're going to bring in what they call a leading economic indicator. All right, now I want to make a special note about leading economic indicators as they are reported. Pay attention to the weights and biases in your leading economic indicators that you are using. Do not use them blindly, okay? I literally just grabbed one of the most popular leading economic indicators. And what I mean by a leading economic indicator is they're a broad-based general pulse of US economic activity, whereas ISM Manufacturing and ISM Services, these are direct measures of manufacturing and services activity in the US economy. So where you would expect a leading economic indicator like the US Conference Board to include both services and manufacturing, if you look at the correlation between these two series, you'll see that the Conference Board is almost a mirror image of the ISM Manufacturing Index. And it shouldn't be a surprise because 4 of the 10 measures are literally direct measurements of manufacturing, and the others are just more macro factors related to yield spreads, S&P 500 performance, that sort of thing. So where everyone starts kicking and screaming here saying the Fed's got to slow down, the Fed's got to slow down, it's going to cause a recession, you can see that from prior recessions, we can actually go a lot further in this contraction because it's primarily measuring this manufacturing activity before we're going to end up getting that services down. So you can see I've actually drawn in some arrows here and highlighted some points of reference. So you can more or less expect this US Conference Board leading economic index, if this is something that you're following, to fall more, right? And you may end up hearing pundits on CNBC and elsewhere, continuing their cries for the Federal Reserve to stop. They're going to break something, where the Federal Reserve is more focused in on what's going on in the services sector, because again, that's 80% of the US economy. So as the Fed, if they're going to continue this fight, right? If we don't know what the Fed's going to do. If they choose to continue this fight, right, you can expect this services index, this ISM Services Index, to continue to fall and bring the ISM Manufacturing with it, more or less drag it through the mud. And you can expect the US Conference Board leading economic index to fall as well, well below contraction, okay? So what does history tell us when the Fed pauses rate hikes, right? It basically tells us that economic contraction is imminent, except for one period in time, and you've seen this referenced many, many times. And effectively in this chart, all we've done is we've swapped out that US Conference Board index with the US Fed funds target rate. And when you look at the target rate relative to ISM, both manufacturing and services, it's remarkable and it's almost undeniable that the Fed is not watching this because the correlations are just spectacular, okay? What I want you to notice is this is our most recent soft landing, right? This is what we pray for, right? We had a massive rate hike followed by a pause. We had ISM manufacturing fall into contraction, and we didn't have a recession. In other words, no gray bar. These gray bars are your recession indicators, okay? But take a look at what happened here prior to the dot-com bust. Take a look at what happened here in 06 and 07. Take a look at what happened here in 2019, okay? You can see that as that ISM manufacturing index approached 50 is when the Federal Reserve actually paused, actually just a little bit prior to that here. And you can see that by that time, the damage was more or less done to the economy. The services index continued to fall, and the Federal Reserve attempted to bring the economy out of the brink by lowering rates and lowering rates and lowering rates, but it was too late. We fell into a recession. Okay, so this is more or less the standard playbook that the Federal Reserve is following. Same exact thing happened here in 06 and 07. The funny thing is that in 06 and 07, I can remember everybody saying, oh, you know, it's going to be a mild recession. And one person said it, and then 5 people said it, and then everybody was saying it. And it's kind of funny because that's exactly what's going on now. Fact of the matter is, we don't know what kind of recession, if we're even going to have a recession. We don't know how deep it's going to be if we have it. It could be shallow. Who knows, right? So when you hear that kind of thing, you just kind of let it go in one ear and out the other. And remember this chart that we're showing you, okay? When the Fed pauses, you're going to get this continued decline. That's what you can expect up until the point at which you really start contracting, right? This economic activity for both services and manufacturing collapses, and the Federal Reserve begins to lower rates, right? At this point, you got your 10-2 Treasury spreads. They begin to narrow. They're no longer wide. They're no longer negative. They become extremely positive, and boom, you fall into recession, okay? So same thing here. So when does the Fed stop raising rates? Or I should say, when is the Fed likely to stop raising rates? To answer that question, we need to look to their own preferred measure of inflation and look at PCE Core, okay? So all we did in this chart is we kept the Fed funds target rate, and we just overlaid PCE Core 1 year percent change on top of it, right? Now, keep in mind that myself and the partners, we've been basically building charts for probably collectively 90 years, okay, 30 years each of us, right? So these charts are drawn properly. Note that this is a single scale chart. This isn't a dual scale chart, okay? So you're actually looking at levels of US Fed funds target rates that are in excess of the current PCE Core. And what I want you to take away from this is that's what it's taken historically to keep inflation at that 2% target level. You can see I've got a horizontal reference line drawn at 2% here. You can see here, right, to keep that inflation low. Well, now, you know, we're still not dealing with this concept of positive real rates because we've got the Fed funds target rate sitting at somewhere between 3.75%. It's 3.75% here in FactSet. They always provide a range, the Federal Reserve does. But keep in mind that PCE Core is clocking in at 4.91%. So when you ask yourself, when is the Fed likely to stop raising rates? And you look at what 80% of US economic activity is still in massive expansion mode due to ISM services, that 12% is ready to fall into contraction. But we're probably going to end up seeing that contract further because we're going to have to get this services number down. What's that going to do to PCE Core, and how much higher are rates going to have to go? This is the argument that a lot of the Federal Reserve Board governors are making, that we're going to have to get this Fed funds target rate above the rate of PCE Core inflation at some point, right? You'll see that I've got these arrows drawn. These are arrows that I just put up here. And these are hypothetical scenarios, right? So at some point, this is going to meet. Now, you've got a lot of Federal Reserve Board governors out there saying somewhere between 4 and 4.5%. I think I've even heard a 5% number. But at any rate, they're going to get there to the point at which perhaps this Fed funds target rate is actually above the current rate of inflation, so somewhere of a meet in the middle. And then they're going to hold that rate steady. Well, we've heard that before, right? We've seen it. I mean, here it is in 1819, here it is 06, 07, here it is in 2000, here it is back in 1995, right? So should we be surprised by that? No, they're running the same exact playbook, okay? So what does this tell us about performance, right? History basically tells us that after a Fed pause, we're going to get a relief rally before the real pain sets in. So you get days like today where we get a hot CPI read, and you just scratch your head, oil's up. You've got the 10-2 Treasury spread sitting at, negative 0.50, which is some of the lowest spreads, lowest negative spreads in history. And you just scratch your head at these types of, bear market rallies. These types of bear market rallies that we have, what people really don't understand is they're stimulative in nature, and they more or less fight the Fed. They fight against what the Federal Reserve is trying to accomplish, and it basically just makes this whole process take longer. Okay, so what I want everybody to see here is that when you get the pause, you get the rally. You see my green arrows here, and keep in mind now this is a dual scale chart. So this is the S&P 500 index, okay, plotted in a log scale relative to that Fed funds target rate. So the manner in which you read dual scale charts is you don't look for a value on top of one another. So here the Fed funds target rate was not higher than the S&P 500 index. And here, obviously, the S&P 500 index is higher than the Fed funds rate. But that's not how you read dual scale charts. You basically look at them as trends across a slice in time or through a cross section in time. And that's why I have these areas here circled in red. I want you to just look at the trend. So we went flat on Fed funds target rate. We increased an S&P 500 price. Same thing here. Went flat, had a huge rally, fell off a cliff. Here we fell off a cliff. Here we rallied, fell off a cliff. So here we are. Okay, what can we expect? Are the bulls going to, rally the market once we get a pause? Probably. Are we going to have a recession? Who knows? But if we do, the likelihood of that ending in a decline in the S&P 500 is pretty good. Okay, so we've got to recognize that both goods and services inflation remains problematic from the Fed's core PE perspective, right? So regardless of the decline in U.S. manufacturing activity, this is a problem. This chart specifically shows that while core goods inflation has retreated, and you can see that in green, you've got core services inflation that's just remained sticky. And this is what the Federal Reserve is really focused on at this point. This is 80% of U.S. economic activity. This is 12%. Okay, here's the 2% inflation target for the Federal Reserve. Okay. Conclusion. Prefer direct measures of manufacturing and services leading indicators over those aggregated leading economic indicators, right? We mentioned the U.S. Conference Board. If you're going to use them, again, just be aware at exactly what they're measuring. Number two, do not ignore services, right? We already know the sector makes up 80% of U.S. economic activity, and when combined with labor market demand, energy, and shelter, this continues, and I put it in bold, continues to be a material contributor to inflation. Example one, September PPI actually reported yesterday, and according to the Bureau of Labor Statistics, right, some 2/3 of the increase in PPI was attributed to a 0.4% gain in services, right? So do not ignore services. Example number two of this, September CPI report reported today, right? Literally just put this in the slide deck this morning. According to the Bureau of Labor Statistics, right, CPI all items up 0.4 monthly versus consensus forecast of only 0.2. It came in hot, right? We had another one of those bear market rally. So this bear market rally we had today, right, stimulative in nature, increases the wealth effect. What's it going to do? It's just going to make this process drag out longer. Okay. Note this, services less energy services up 0.8%. I'm not making this up. This is the actual table right from the Bureau of Labor Statistics website. Here's your 0.8% on services less energy services. Here's your all items 0.4. So the takeaway here is that No one knows precisely when the Fed is going to stop raising rates. But what we do know is that the more investors continue to fight the Fed, the longer this process is going to be drawn out. Thank you all for attending. That's about it for today's session. Be sure to join us next week when we explore the likelihood of the U.S. entering a recession in 2023. Thank you.